Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. All right, speaking of Bloomberg Intelligence, I'm reading some research here. It says, most commodities are melting except for gold. What stops it? Let's go right to the person who wrote this stuff, Mike McGlone. He covers all the commodity stuff. He's a senior macro strategist for Bloomberg Intelligence. Mike, what are you thinking about these days in terms of the commodity space? What are you telling your clients? What are the conversations you're having with your clients about commodities?
Well, hello, Paul. I appreciate you reading that headline because it's something I like to reiterate periodically, particularly when it's relevant, is typically historically over time, gold is the best performing commodity. Now, basically, because it's not really a commodity, it's a store of value. It's a metal. I mean, you can store it on your body in terms of jewelry, but certainly lately it's been the key case. It's the best performing commodity this year. It's up 10%, and the average of the Bloomberg Commodity Index this year is down 16%. And the key thing I like to ask myself is, those are bodies in motion. And as a strategist, I say, okay, is it going to stay the same, reverse, or accelerate? I think it's more likely to accelerate, particularly at some point if we get to a point where the Fed pivots. It's going to happen. But that's the bottom line is we had this massive pump in commodities last year, and they're proving what they always do. Elasticity, supply demand makes commodities their worst enemy. It's the higher price cure, as the farmers say.
Well, but that's interesting, though. I feel like we're a far bit away, at least if you listen to Jay Powell on Friday, from when we see the Fed reverse course. I mean, talk me through the timeline there. When would you expect gold to start showing some outperform? I mean, I guess it is showing outperformance, right?
That's the point. Gold's looking ahead, and that's a key point. They will probably not be cutting rates anytime soon, particularly in my view, until the stock market tells them to. And that's part of the lose-lose for risk assets. There's then a high connection and correlation between stock market bouncing this year, all this massive fiscal stimulus, and the Fed hiking another 100 basis points. They are still on that hiking trajectory. Despite then you look over at commodities, what's the number one source of demand historically, at least the last 20 years or so, is China. Demand estimate revisions heading lower in China are just getting started. So their key customers, their key export customers, U.S. and Europe, are in these early days of just showing signs of what you expect from high interest rates jumping. And then, of course, the leader of China, President Xi, cozied up with Putin right before the war. So we see that tilt just get us out. And so that to me this is early days. So I look at this as what's is potentially a very bearish scenario for commodities. And you look at yourself, so what's going to change is typically also you need a weak dollar. And for the dollar to get weak, we have a major issue there. It's the hardest to, most expensive to short commodity or currency on the planet, particularly if you look compared versus the top commodities and economies on the planet, China, Japan, and Germany. U.S. is just a much higher rate. So that to me is basically a train wreck heading for commodities and for deflation.
So, Mike, I know you come from the land of the great American farmer. I wonder how the American farmers doing here. I'm looking at corn down 30% year to date, soybeans down 8% year to date, wheat down 26% year to date. How is the farmer doing these days?
They are crushing it. So
even with prices down so much.
Oh, well, down from where they were. So corn right now, the number one, as I'm going back next week, and lesson I learned growing and raising, having owned the farm in the Corn Belt, we plant soybeans so we can plant corn. We plant corn because that's what we do and that's where we make our money. It's the world's most significant commodity.
Wait a second, you plant soybeans to plant corn? Why? How's that work?
It's a rotation because soybeans add nitrogen and fertilizer to the soil. And they're a legume. Corn takes it away. It's very nitrogen expensive. It's a grass. It's just that rotation that the Corn Belt has crushed. But the bottom line is partly because of this war in Europe, you've had prices well above their costs of productions, and the costs of production, for instance, anhydrous ammonia is collapsing. And so we're making a lot of money. It's just called profits. What do profits mean for farmers? Production. So this year is probably going to be close to the biggest production year ever for corn. Just in the weather's not so great. And also what it What did it do with corn and soybeans in Argentina? And I'm sorry, in South America, but most notably in Brazil, record production. I mean, off the charts. So this is just a normal elasticity of supply and demand in the area of the commodities we can bring on that supply in 1 year. And the bottom line is they're making a lot of money. And that means more supply, more production, and it means typically lower prices. But I'll just end with this. September is the worst month of the year for grains, typically because of harvest. And that's how futures came about, because they needed to start hedging, most notably when they all try to sell at the same time.
And I've been looking at, I've been pulling back a little bit our commodity price for corn, and
right.
we're still at levels where we were in late 2020, but those are substantially higher than where we were in previous to that.
Yep.
Talk me through, Mike, what's happening in wheat, because we have all this stuff with the grain deal and Turkey. Very interested to see where you think this is going also.
So the significance of wheat is that was at the epicenter of what happened with Russia's, President Putin's invasion of Ukraine, but it's been in a straight downward trajectory since reaching that high last year, right around $13 a bushel. But typically what wheat does, now it's back to a level that was kind of enduring before, because what happens is you can bring on wheat supply rapidly, and it's the most widely grown agricultural crop. And almost every country in the world can grow wheat. Now, Ukraine was a big exporter. U.S., we export over 55% of our wheat. We grow less of it every day because it's so much easier to produce. It's basically considered a weed. And it's one commodity you never want to be long after it goes up. It's just the way it works because you bring it on. So wheat's been a good indicator. Right now, it's around $6 a bushel. And I view it's all going to continue to trend lower unless we get some kind of surprise out of that war, which means hopefully not, but something nuclear could do. But this is a situation similar to World War II for the grain belt, the corn belt, which is where I'm from, and that is prices. And the war in Europe kept prices rather high, which meant U.S. did very well, created more and more production and profited, and then it all collapsed once the war ended and we had way too much supply. That is the risk, and that's markets are looking ahead to that.
So real quick, WTI crude oil, we're going to switch gears here. $80 a barrel seems to have found a little bit of a home here for a while.
Yes, it's happy. It's consolidating well. It's the same price as, I'll put this back into history. This price here was first traded in 2007. Now, imagine if we said that about the stock market. Yet, over that time period, the PPI is up 50%. In terms of gold, here's one for you. It takes 0.042 ounces of gold to buy 1 barrel of crude oil. That's the same price as 1931. Crude oil is the world's most autocorrelated asset and has a lot of reason to continue trade lower after that big pump last year. 15% of all sales of EVs in the world now are automobiles are EVs. And then, of course, that supply out of the U.S. The biggest thing that's pressured crude oil the last at least almost 15 years is the U.S. We just create much more than we need. And with Canada, our surplus every day is about 4 million barrels a day of liquid fuels. So we can fill up the SPR, the Strategic Petroleum Reserve, in just a few months.
Interesting. All right, Mike, always learn something with you. You put in soybeans to do corn. I learned that's new. Mike McGlone, Senior Macro Strategist and Bloomberg's resident farmer for Bloomberg Intelligence.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
The IPO market looks like it might be heating up a little bit. Had a couple of filings late last week. ARM Holdings, the chip maker, and then the grocery delivery company, Instacart. So we want to talk about that deal. Brianne Lynch joins us. She's head of market insight at EquityZen. She joins us here. So Brianne, talk to us about Instacart here. What did we learn from their IPO filing last week?
Yeah, thanks for having me. I think Instacart really painted a picture in that filing of what companies are going to need to show if they want to have potentially a successful IPO. So this is a company that is growing. They grew transaction revenue 39% year over year. They're profitable with 15% operating margins, which a lot of other players in the gig economy space that are public, like Uber, Lyft, Dash, they all are not presenting, profitability yet. And this is both a brand that people recognize and a business model that people know. So definitely a strong one that could potentially open up the IPO market for others.
Well, the interesting bit as well to me, and we were talking with this about this with our equity reporter Bailey Lipschitz earlier, is that this company had been valued much, much higher as of 2021. I believe $39 billion, according to PitchBook. And now, the valuation here are going to be maybe 70% less. Talk to me about how investors kind of get comfortable allowing this company or going along with the company's plans to IPO here. How does this change the dialogue between the company and its existing investors?
Sure. So Instacart has already been priming its investors about this. So while they did raise that $39 billion round in 2021, their internal valuations have gone as low as $10 billion, now closer to $13 billion. So this is for the equity that they're issuing to new employees or, new stock grants. That's the valuation that they've given themselves. So internally, at least, they've accepted that haircut. And I think that's ultimately the tough pill that a lot of these venture-backed companies are going to have to swallow. As we raised money at a crazy valuation in 2021. It's not where the market is anymore. And if we're going to raise capital in either the private or public markets, it's most likely going to be at a discount. And I think investors understand that as well, just given where multiples are. With the case of Instacart, you have Dash as a public market competitor. That's a pretty good comp that helps from a valuation perspective.
So speaking of DoorDash, Brianne, I mean, this has become a crowded space really since the pandemic as this market's really developed and evolved. Where does Instacart kind of position itself in terms of its competition, whether it is DoorDash or Uber Eats or Amazon and all that type of thing?
Yeah, so they're by far the market leader. Both Uber and DoorDash have less than 1% of the grocery market, and it's a market that they're aggressively pursuing, but they still are not big players in it. When you look at all of the grocery players, Instacart has partnerships with over 85% of them. And this is a $1.1 trillion market. The largest retail market is grocery. So it's a huge market where they are already the leader. So there is a lot of competition, but they are 1 foot ahead. But to your point, it's not just these other kind of gig economy players they're up against. They're up against Amazon Fresh. They're up against Walmart grocery and other players that, have a lot more resources just from being bigger companies. So there is a lot of competition.
Yeah. Does that competition scare would-be investors in this space at all? Because you think of Amazon coming into any space and it's just sort of has the potential to be transformative, even if they've struggled a little bit with expanding their grocery footprint.
Yeah, so they got a strong vote of confidence by Pepsi, who's investing $175 million in this IPO, and a lot of the thesis or the bull case that they see is around the advertising piece of Instacart's business. So about 30% of their revenue comes from advertising. So when they highlight different products on their marketplace to users, and this actually helps diversify their revenue stream in ways that some of these other players haven't done yet. And it's also the piece of their business that is driving their profitability. So that's kind of a unique or a strong point that they have now that investors have found compelling.
Growth has slowed a little bit for this company. Is that just a post-pandemic kind of evening out of this marketplace in terms of number of subscribers and in terms of that metric?
Yeah, in terms of, I would say they haven't saturated the market fully, but they did see such growth during the pandemic that it's probably more about activation. So of these customers you have who have used Instacart, how do you get people more captive on the platform? They haven't admitted and understand that it's not going to be online only for every customer. People will still be going to stores. So it's more about, activating those customers and then just improving their margins, amongst those who are transacting. So they have grown revenue. They've grown average cart size over the same period. So even if their customer base isn't growing, their revenue is growing.
We saw as well a filing by ARM for its mega listing believe it was a filing. But
Yep.
what threads are there here for you that you're starting to see evolve in the IPO space? Because I think there was a fair bit of hesitancy for a while, just given what had happened to IPOs in 2021. And now maybe we're turning around?
It looks like we're starting to turn around. This year has been the worst year for IPOs since 2009. We really haven't seen that many blockbuster names hit the market. And Instacart and ARM, those will be the largest IPOs in the US since Rivian in 2021. So definitely starting to signify this turning tide. And ultimately, you have over 1,400 unicorn tech companies sitting in the private markets, many of whom have been waiting for the right opportunity to have an exit. Their investors are ready for an exit. Their employees who maybe have gotten some liquidity but are looking for, broader liquidity, are looking for an exit. And I think the fact that, while there's been some recent market volatility, you have the NASDAQ up 30%. You've seen a few successful IPOs, though not tech IPOs, like Kava, Oddity, and Kenvue hit the market. People are feeling a little bit more comfortable, like this may be the time if they're looking to exit this year.
I think for a lot of investors, I think for me, the thing that jumped out at me is, as Simone was mentioning earlier, the dramatic reduction in valuation. I think that's kind of been a gating issue for a lot of these companies not tapping the public markets because they didn't want to take that big write down on valuation. Is the expectation that maybe Instacart will maybe open the way for more companies to kind of bite the bullet, if you will?
Absolutely. I think Instacart doing this and kind of taking it on the chin is going to open the door for others who realize it'll become less taboo, essentially, as more companies accept these valuation write-downs. It becomes less of a negative and just more a reflection of how multiples have corrected. So I do think that they will make it easier for other companies doing this as well. Klaviyo is another company, a marketing automation platform that also filed their S1 on Friday, got a little lost in the Instacart news. But this is a company that raised at a $9.5 billion valuation in 2021. So they're likely to be one that is, trading down from those levels as well. So it's just kind of a reality for where we are in the market.
All right, Brianne, thanks so much for joining us. Really appreciate getting your thoughts there. We're getting some IPO filings starting to hit the tape, maybe get a little bit of a action in the fall here with the IPO market. Brianne Lynch, head of market insight at EquityZen. And again, you like to think maybe we're going to get a little bit of deal activity once everybody comes back from the summer.
Yeah, I mean, busy Friday, even though Klaviyo is not quite as large a company and likely will not be quite as large a company when Instacart.
Yeah, Instacart, it's going to be a pretty big transaction. We're going to have all the big investment banks are there. This deal is being led by Goldman Sachs, so it'll be certainly a deal that people will pay attention to. And there are some comps out there, as Brianne was mentioning. So see how that plays out.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're talking about VinFast, what a crazy name that is, story that is. The exact opposite might be Minnesota mining and manufacturing. 3M, you're talking industrial heartland, been around forever. I'm looking at the stock over the last 5 years. It's down 10% on a compounded annual basis, whereas the S&P is up a little more than 10%. So really underperformed the market. But they're in the news today, and we want to talk about 3M. We want to talk about industrial America and what's happening out there. Brooke Sutherland, she covers all of that so well for us. She's a columnist covering industrials and deals for Bloomberg Opinion. She joins us live here in our Bloomberg Interactive Broker Studio. So 3M, I guess the story today, Brooke, is agrees to pay more than $5.5 billion over combat earplugs. Can you give us the background of this story?
Sure. So 3M sold, they were dual-ended earplugs to the U.S. military through its Aero Technologies subsidiary, which it acquired. And the idea was that on one side, it would sort of block out everything, and the other would block out sort of immediate near-term gunfire sounds, but you could still hear the person sitting next to you, which obviously has a lot of appeal for the U.S. military. But the veterans have claimed that these earplugs did not in fact work and left them instead with hearing loss and tinnitus. And so this has been sort of a mushrooming legal challenge for 3M. Veterans were increasingly winning bellwether trials, and 3M then made the move last summer to put the Aero Technologies subsidiary into bankruptcy as a means of sort of speeding up the resolution of those claims. Now, a judge earlier in June said, you can't do that. This is not a valid reorganization purpose. And, the company was appealing that, but it looked like a rocky road. We've seen J&J run into legal challenges with a similar ploy involving some of those talc claims for that company. And so it looks like the company 3M is instead moving toward a settlement, which makes sense. I mean, this was really the only way that this probably was going to end for the company.
Now, I understand that there are more issues that 3M's face, but first, is this it for this specific issue? Is this likely to kind of settle all the claims around the earplug issue?
Sure. So we don't know a lot of the details, and so Bloomberg News has reported on this Sunday that this was in the works. It's a tentative deal at this point. I think it'll be interesting to see what the actual details look like once we get the final paperwork. One of the things that's been reported is that this settlement would be paid out over 5 years, which is not what Wall Street was expecting. If you think about the type of hearing loss we're talking about, if you lost your hearing because you were exposed to very loud gunfire, this is not something that plays out over time, that you're sort of waiting to see happen like you would with cancer claims.
Okay.
So I think analysts had been bracing for more of sort of an upfront payment. So it'll be interesting to see what that actually looks like. But theoretically, I don't think they would be moving forward with something like this unless they thought it was really going to put this issue behind them. Now, there will be sort of ramifications down the road. I do think you have to worry about a dividend cut at 3M, just given the fact that they've also separately agreed to a up to $12.5 billion settlement regarding PFAS in drinking water. But that is not the end of their PFAS liabilities by any stretch. And I think that dividend is just going to be under pressure here.
Yeah, the dividend yield looking just about 5.8%, so that's some risk there. For 3M, I mean, were these hearing aid issues just from since Afghanistan and Iraq from that time period, or is it even before that?
I'm not sure exactly on the dates of the claims, but like I said, this has been sort of a mushrooming issue that has certainly
and the stock's up about 3 or 4%. So I guess the market was thinking maybe it would have been a bigger number, maybe.
Sure. And so, a lot of analysts have been bracing for something in the $10 billion range. And, I think the stock is up because, quite frankly, any progress is good progress for 3M on its legal issues. The stock has lost more than $50 billion in market value since CEO Mike Roman took over in 2018. Like you said, it's been a serious underperformer. And some of that has to do with execution issues, operational hiccups within the company, tougher industrial markets. But a lot of it has to do with these legal liabilities that have just been hanging over the company's head, and they're very open-ended, and nobody could really put a number on it. So the fact that we now have a number that we're talking about, I think, is a relief to shareholders.
Yeah, can you talk to us a little bit about these PFAS obligations? There's one $12+ billion, but there may be more than that.
Sure. So the settlement that they've agreed to covers claims that PFAS polluted drinking water supplies, and that's with U.S. public water systems. But
these are forever chemicals. Exactly. They exist forever. You ingest them somehow, and then they're bad.
So 3M manufactured them for a range of products for years. They stopped making some of the most problematic compounds several decades ago, and then more recently have come out and said we're getting out of PFAS altogether. But so we're talking about legacy manufacturing from years and years back. So the settlement involves drinking water claims, but then there are also potentially liabilities involving state attorney generals, potentially the EPA, the military. Then there are also foreign governments to consider because 3M has factories all over the world. So Barclays analyst Julian Mitchell has put some of these outstanding liabilities at about $16 billion, in addition to the $12.5 billion that we've been talking about. And that does not include any sort of deals with the foreign government. That's just U.S. One of the biggest buckets is personal injury claims, property damage claims. They just brought in a very big lawyer, or trying to bring in a big lawyer to help with some of those claims. He was the one who got the big tobacco settlement. And so I think we could still see some big multi-billion-dollar settlements.
Brooke, you cover a lot of the big industrial companies. A lot of those companies are conglomerates. And conglomerates, it seems like from time to time, are in favor. Sometimes they're out of favor. I've pitched it both ways as a banker, which way the winds are blowing. You have a fascinating column out on that. Where are we now with just conglomerates? Do investors like them? Do they not like them? What's going on?
So it's interesting because we went through a moment during the pandemic where all of a sudden diversity was an asset again, because it was very helpful to not just be an aerospace company, for example. But even beyond that, you sort of had different markets recovering at different rates as we came out of the pandemic. And you actually heard a lot more companies talking about diversity as an asset. And that message is not resonating in the same way now that we're sort of on the other side of that initial robust COVID comeback. And we're sort of seeing some markets slow down, other markets being more robust, and diversity is becoming a liability again. Now, there's not that many big diversified industrial conglomerates left, because so many have done breakups, spin-offs, what have you. Even 3M is planning to spin off its healthcare unit at the end of this year. But there are a couple, and I think, we may see them come under more scrutiny.
Is this a cyclical sort of thing? Because aren't there various times, over when you look over periods of decades where it helps to be diversified because it helps insulate you from some risk, and then all of a sudden, the market recovers and activists say, get rid of your XYZ division?
It definitely is cyclical. And to your point, it's one thing to argue that diversity is a liability, and then when times get tough and you're just an aerospace company, then the numbers don't look so great. But I do think it goes in waves. And one of the comments that the industrials always make is if you look outside of manufacturing, look at finance, for example. Some of the big banks are in a wide variety of businesses. Look at the tech companies. Amazon will deliver goods to your front door, but then they also sell cloud computing services, and they own Whole Foods. And so there is, a number of examples of conglomerate out there in the markets. And I think one of the ironic things is for all the times that this business structure has been pronounced dead, it actually has quite a lot of staying power and just reincarnates itself into sort of different visions.
What are you working on these days? What's the next cool thing coming out of your Bloomberg terminal?
Oh, well, all kinds of things. But certainly watching this diversity issue and how it plays out, I think will be really interesting. And we haven't really seen a lot of activist investors in the industrial sector for a while. The last big time I can remember somebody pushing for changes at an industrial conglomerate was in 2019 with D.E. Shaw and Emerson Electric.
And
so it's
Emerson,
been a while.
And Emerson did do some things,
They
right?
did break up, although that was not so much... I don't know how much that was connected to the activists. They got a new CEO who had a lot of energy and a lot of vision for what he wanted this company to look like, and I think that was sort of more the driving force in that case. But we really haven't seen that many activists in industrials, which is fascinating. And so I wonder if, now that sort of the pendulum is swinging the other way on diversity, diversity of businesses, if we might see, some activists come out of the woodwork and take a look at these companies. Honeywell stock in particular has been under pressure since they announced a CEO change. And I think investors are just sort of waiting and watching to see what that new CEO, Vimal Kapur, might do with that mix of businesses. They're sort of the last remaining really big industrial conglomerate that has not done a massive spinoff. They spun off 2 smaller businesses in 2018, but we haven't seen the kind of full-scale breakup we've seen elsewhere.
All right, Brooke, thanks so much for joining us. As always, Brooke Sutherland, columnist. She covers industrials and deals for Bloomberg Opinion, joining us here on all things industrial, including Minnesota mining and manufacturing.
You're listening to The Team, Kantar Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Our next guest, I would say, just feels like consistently bullish on the state of California. Several weeks ago, we discussed San Francisco, and the numbers bear out a bullish outlook there. Today, it's the City of Angels, Los Angeles. Matt Winkler joins us. He is the founder of Bloomberg News. He is the editor emeritus right now of Bloomberg News, joining us via Zoom. Matt, when I think LA, I think Hollywood because I'm a former media analyst. And Hollywood's kind of on its backside these days with the actors on strike, the writers on strike. Tell us about what the numbers show you about the health of the LA economy.
Always great to be with you. And truth be told, it's not just Hollywood actors and screenwriters. At some point this year, you've had airport shuttle drivers, boat captains, crane operators, sanitation workers, heavy-duty mechanics, custodians, longshoremen, which handle, by the way, 40% of U.S. imports from Asia, and nurses and school teachers, all on strike. However, that pervasive perception of paralysis, if you like, is really belied by the reality that not only does Los Angeles still work, its 10 largest publicly traded companies are number one in sales and employee growth among the same group of firms based in each of the 10 most populated U.S. cities now and for the foreseeable future. And what are we talking about? The 10 run the gamut from banks, financial services, insurance to consumer discretionary, staples, industrials, healthcare. They're doing better as a group than any top 10 companies in any of the top 10 U.S. cities.
Now, does this analysis that you've done here apply to having more people work from these firms in LA itself, or is it just simply that these firms are based in LA, they're successful? I guess I'm trying to connect the home base of these companies and actually bringing benefits back for the city itself.
Okay, so that's a great question. And of course, none of this would be meaningful unless, as you query, all of the people we're talking about are in LA proper. And we are talking about employee growth within Los Angeles, not outside Los Angeles, inside Los Angeles. And there really is no city that, comes close to this double-digit sales gain from its top 10 firms. San Jose, by the way, is the closest firm at 10%, and LA is way above that, and way above Chicago, Phoenix, Philadelphia, San Diego. They're all distant also-rans. San Antonio and Dallas are going to have average revenue declines. So LA really is out front here, and employee growth, it's the same story all over again. So, and you can see that, by the way, on the Bloomberg terminal. If you were to graph Los Angeles, for example, against the Russell 3000, which is big and small companies alike, publicly traded, the gap between the two has widened. It may be close to a record, actually, right now.
Hey, Matt, if I were to listen to the leaders of states like Florida and Texas, I would get a different narrative. It seems like everybody's leaving California, the high taxes, that's not pro-business. They're coming down here to low or no tax states. What does the data show you?
You could fit Florida, maybe a couple of them, inside California.
Yep.
Without missing a beat.
Exactly.
You could fit probably all of corporate Florida inside of LA and not miss a beat. The point is that California is huge, all right? Let's be clear about this. So there's been according to the census, a 3% decline in population since 2020 in Los Angeles. Having said that, California is 39 million people, okay? That's at least 10 million more than any other state. Texas is number 2. And then corporate California dwarfs corporate anywhere, corporate Texas, corporate New York, corporate Florida. You could fit any of those economies comfortably into California without so much as a bulge. That's the reality. And, look, George Orwell said this best. He said, to see what is in front of one's nose needs a constant struggle. And that's really the reality for California, and particularly Los Angeles, is that it's a very diverse city. By the way, it's still got the largest manufacturing base, that's 500,000 plus people, of any city in the United States. So it's not only, a place where you have, if you like, Hollywood screenwriters, but you also have aerospace going back decades. And that's just a bigger footprint than anywhere else.
Interestingly, Los Angeles is one of those places that's struggling with these empty office, or not empty, but much high office buildings with very high vacancy rates, to the point that their owners are sometimes giving the keys back to the banks. Do you get any sense of how Los Angeles is going to tackle that problem? Is it any different than somewhere like San Francisco might be trying to tackle that problem?
Well, look, it's early days. We're talking about a period really since the pandemic, which was unprecedented in our lifetime. So who's to say, what kind of calamity this really is? Certainly in the short term, it seems so, but look, one of the people that we have followed closely is a 33-year-old co-founder and chief executive officer of a company called Relativity Space. It's an 8-year-old startup, made the first 3D printed rocket to enter space, That's the 110-foot Tehran 1. It's the largest metal object 3D printed. Okay, it's right in the backyard of Los Angeles. It's actually in Long Beach, but it's close enough, and their offices are in Los Angeles. And he'll tell you, speaking about downtown and everything else, that most of his friends are engineers, but he's friends with artists, people in fashion, people in other industries. And that's the kind of innovation and mentality, he says, that would take to do something as crazy as put 1 million people on Mars. And I forgot to mention, he's from Plano, Texas.
Right.
Okay. He loves California. So be careful, what the prevailing narrative is, because this being Bloomberg, you look at the data, and as our owner likes to say, in God we trust, but everybody else bring data.
Hey, Matt, thanks so much for joining us. Matt Winkler, he is the founder of Bloomberg News. Fascinating column on the great city of Los Angeles and how well it is doing economically at this point.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Goldman is offloading a wealth unit to $240 billion money manager. Shri Natarajan reported that story. He joins us here in our Bloomberg Interactive Broker studio. Shri, what is Goldman doing here? I thought they liked the wealth management business.
Well, they still like the wealth management business, but what they're doing here is another strategic flip-flop, and we've seen a little bit of that over the course of the last 12 months. This is a RIA investment advisory business that purchased in 2019 for $750 million. Goldman has a dominant presence when catering to the ultra-rich, the ultra-high net worth individuals. No one does it better than Goldman. People who have $25, $30, $50 million per account. The mass affluent market is one where people could have $1 million account. Like on average, $1.2, $1.3 million account is what they got when they purchased United Capital with about 22,000 clients. 4 years in, they've realized that really is not where they want to be. It has been a little bit of a drag on their profit pre-tax margins as well. So they've decided to shed that. They're selling it to this $240 billion wealth manager called Creative Planning, which is run by a very interesting gentleman by the name of Peter Mallouk. But for Goldman, what that means is you refocus your attention on the part of the business that you're really good at, which is serving the ultra-rich. It mirrors some of their stumbles with consumer banking, which is something we've spoken about a lot over the course of the last year. Again, another way to expand beyond their core roots and go into this retail banking markets. And in many ways, I think it's fair to call it an attempt that flopped. And they're getting out of much of that through trying to sell off its credit cards businesses, trying to sell off the installment lender it bought, shutting off its lending platform for consumers. All that they have left is that Marcus savings business, which, by the way, is very successful, is a big benefit to Goldman because it doesn't mind accumulating deposits that way, because what it has to pay out on that is less than what it has to pay out when it has to raise money from the market. So that they will stick with. But pretty much every other vestige of their consumer banking foray is either being, chucked overboard or in the process of being chucked overboard.
Well, yeah, so this was purchased, United Capital, this RIA was purchased for $750 million back in 2019. Where does that $750 million go?
That's a good question, because when Goldman announced the deal, which came a little bit after our story a few minutes back, they did confirm the sale of this business. They didn't give us a price, so we don't know what price this platform fetched, but they do have an important line in their press release that says when this deal closes, which they expect by the end of the fourth quarter, there will be a gain, there will be an accounting gain. That doesn't necessarily mean that the buyer is paying more than $750 million. But the way with most of these transactions is you buy something, you have some goodwill, that goodwill gets amortized, depreciates over the years. Relative to that, I think you will see an accounting gain. And I think that's what they're signaling at, rather than necessarily telling us that this is something where they will get in excess of $750 million.
Shri, at the beginning of this discussion, you characterized this deal as perhaps a flip-flop. Investors don't like flip-flops. What's going on at the senior ranks of Goldman Sachs here? A lot of flip-flopping in terms of what they own, what they don't own, strategies.
Two ways to look at it, right? When David Solomon took over in October 2018, there were two key pillars, which is expand the businesses you're really good at, grow earnings there. They hugely benefited from that boom in trading and deal making set off by the pandemic and every other dynamic that continued after that. But the other important pillar for David Solomon and his management team was to try and improve the stock multiple, try and convince investors that the stock is worth a lot more, that their price to book ratio, price to earnings, whatever fancy technical metric you want to throw out there, deserves more. They haven't really succeeded in doing that.
Okay.
There's been a lot of book value growth because of earnings growth, but not any success in convincing investors that you can do the multiple growth. Maybe now that they've done a strategy pivot or have done this flip-flop, they're perhaps in the place where they want to be, and maybe investors come on board.
All right, Shri, thanks so much for joining us. Glad you could join us here in studio. Shri Natarajan from Bloomberg News. He covers Goldman Sachs. He covers the big investment banks. He is all over Goldman Sachs, and including some of the recent changes in strategy.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hawaiian Electric Industries, the stock's up 43%. Looks like the company's saying, hey, wait a minute, maybe we're not so much to blame. Maybe they're putting out a statement on maybe there's some other causes here.
And as Bailey was talking about, it's still down 67% this year.
Yep. So it's interesting. So we'll have to get the latest here. But let's do that with an analyst who covers the bonds here, covers the credit side of the utilities. Jaimin Patel, he's a senior fixed income strategist for Bloomberg Intelligence, joining us via Zoom. Jaimin, what do you know about what's happening here with Hawaiian Electric? Quite the turnaround here.
Well, we're really very much in the early days here, right? So you've had allegations being filed, you've had some responses, you've had some findings, but over the next weeks, months, as the PG&E case showed us, this sort of thing can take a really long time. There'll be more findings, there'll be more allegations, and so on. But this latest one seems to be very interesting. Up until this particular statement that came out from the company, Hawaiian Electric had really not mentioned anything about de-energizing its lines. In fact, it had said that it didn't de-energize its lines simply because they were concerned about emergency usage, hospitals, etc. That would be damaged, obviously, if the power is turned off. But today they came out with a statement saying that the first fire, the one that occurred in the morning, had been contained, and then according to the Maui Department of Fire, it had been extinguished. Then the second fire, which was the one that I believe created most of the damage, didn't really start till about 6 hours later. And they apparently, or a little bit more than 6 hours, they had de-energized their lines, presumably because of the first fire. So at the end of the day, it really depends upon the findings that come out over the next few weeks and months, what the courts decide, and then how that liability is apportioned.
All right, so just the Bloomberg reporting here. Hawaii utility soars after pointing blame for the fire at the county. Hawaiian Electric says power lines de-energized before the fire.
Yeah, and I guess the interesting bit is there is that they're sort of drawing this line. This was not a continuation of the first fire, but rather a second fire. And of course,
yeah, exactly. I think what they, what the litigants, maybe not the county so much, but certainly the litigants will try to claim and try to prove is that the first fire had not been extinguished and had eventually led to the second fire. If that's the case, then the question becomes, well, is Maui County through the Department of Fire liable at the end of the day? And in addition to all of this, I think you sort of have to kind of take a step back. What's going to affect the bonds and the equity, which is where we'd started this. The whole question depends upon how much the liability is, how much HE is determined to be responsible for, how much of it will they share. And then once that's determined, will that be tax deductible for the company? Because that obviously reduces the overall liability. And then whether the regulators will allow them to recover that liability, as well as obviously the restoration costs that they have to go through rates. If they don't, that's obviously not good for the bonds and certainly not good for the equity.
So, Jaimin, what has the company done to date to maybe from a balance sheet perspective to prepare for maybe some downside scenarios?
Well, so far they've there's not much they can do on the balance sheet side, but they have tried to shore up their liquidity. They drew down the 2 revolvers that they have, one for $170 million up at the parent, and then $200 million down at the intermediate parent, Hawaiian Electric Company. So that plus any dividends that may come up from American Savings Bank and any cash that they have on hand will hopefully take them through the restoration period through to the end of the year, so that they can get their power up and running to all the customers that don't have it at this point.
Now I'm looking at bonds of Hawaiian Electric due in December 2028. It looks like they're trading around 86 cents on the dollar. How should we interpret that, Jaimin? How dire are things for the company with respect to its creditworthiness?
So you have to sort of differentiate between the bonds up at the parent level and then the intermediate holding company and down at the utilities. The parent level bonds have, and this is sort of what differentiates Hawaiian Electric from PG&E. PG&E had just the electric utility as its only subsidiary. Hawaiian Electric has American Savings Bank as a separate subsidiary through which they can upstream dividends in the normal course of business to continue to service their debt. Down at the utility level, you don't have that. Everything is purely dependent upon the earnings at the utility in terms of the ability to service debt. But I think we haven't seen the bonds move as much today, as certainly not as much as the share prices. I think 2 reasons for that. One is the liquidity. Most of these bonds are privately placed, don't trade as much as you would expect. But 2, also the junk ratings on the bonds, right? And the bonds are going to trade in line with their ratings until there is a change in those ratings.
So, Jaimin, for these utilities, whether it's the out in California that we saw several years ago, or here in Hawaii, there's just a ton of risk that these utilities have in a world of climate change and more and more fires, some of which are caused by utility lines. Is there any way for them to insure against that? Or if you're a creditor or you're a shareholder, you just have to assume this growing risk going forward?
Yeah, so most of the transmission assets that are owned by utilities, and those are the ones that are generally the most susceptible, whether it's to hurricanes or to wildfires, are generally not insured. And the understanding there is that if they are damaged, regulators will allow the utility to recover through increased rates, recovery of those assets, and to rebuild those assets. Certainly that's what we saw with Entergy New Orleans when Katrina hit. That's what we saw with CNP and FP&L when both those were hit by hurricanes. It remains to be seen what's going to happen over here. At PG&E, there wasn't the full recovery because PG&E was found to be liable to a significant extent. So I think utilities are not those boring investments that they have traditionally been, sort of buy in and put away. I think you've got more risk perhaps at individual utilities than at the holding company. To the extent that a holding company owns more than one utility, diversification is probably the way to go. You have a utility that's operating in one jurisdiction and in different geographic localities as opposed to another. So when you've got multiple utilities, you've got a little bit of diversification that helps to prevent a hit up at the parent level and for the equity.
Yeah, that's interesting. And is PG&E, is that the sort of situation that we really should see as indicative of how this might play out? Or do you think we could see some sort of answer as to who's liable, et cetera, more quickly? And I'm sorry, we have only about 20 seconds here.
So in terms of your question is are we wondering how this is going to play out in relative to PG&E? So PG&E is, obviously you had a much bigger utility. The advantage that PG&E had as it came out of bankruptcy was it shared California primarily with 2 other solid utilities, investment grade utilities. So California was able to set up this wildfire fund, $20 billion plus, which all of the utilities have had to contribute into and will continue to contribute into and will be at least partially be able to recover through rates. That's sort of, I don't want to use the word subsidizes, but maybe that is the one that comes first to mind. Subsidizes PG&E's liabilities with the other 2. But of course it works all ways, right?
Yep. All right, Jaimin, thanks so much for joining us. Really appreciate you getting some of your analysis here today. Big news for Hawaiian Electric. Jaimin Patel, Senior Fixed Income Strategist for Bloomberg Intelligence, joining us from our Bloomberg Princeton campus.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.